something happened to Germany's gold, and now they're considering again withdrawing more gold. And it wasn't from COMEX; it was from the Fed itself. So it was from New York vaults, but it was being held by the Fed, as I understand it. And I think it just makes sense that more and more, the more lies, outright lies that are discovered to be outright lies is ruining confidence of foreigners. And foreigners are saying, hey, we want our metal back. We want it back. We want to hold it, because if it's in your hand, you have it. If it's held at the Fed, they're probably bullshitting you and your metal's already gone. So I think this is a move to basically take reserves and re-homeland them by foreigners.
According to the Bunker blog, the United States holds the world's largest gold depository and stores much of its gold domestically. Other countries that are doing the same include France, Russia, China, Turkey, Taiwan, Saudi Arabia, the UK, and Spain. Many nations, however, don't disclose where their reserves are kept, raising transparency concerns. Some still store large portions abroad. Italy keeps about half its reserves in New York, and Lebanon stores around 40% there. Recently, though, central banks have begun repatriating gold. In 2014, the Dutch central bank brought back 122.5 tons from New York, citing the need for domestic access during crises. Despite holding reserves in New York, Ottawa, and London, the move signaled growing unease over relying on foreign vaults. In June 2024, the Reserve Bank of India moved 100 metric tons of gold from the UK to domestic vaults, its most significant transfer since 1991. Despite holding 822 metric tons, much remains abroad, signaling a shift toward greater physical control. BillHolter, a former Wall Street trading branch manager, believes this shift reflects rising global skepticism about the security of storing gold overseas, particularly in the US. He argues that countries are beginning to understand that if their gold isn't physically within their borders, ownership becomes uncertain. Holter also links this sentiment to broader concerns about the global financial system, which heavily depends on U.S. treasuries. Unlike gold, which has intrinsic value and limited supply, U.S. dollars can be printed without limit. This ongoing money supply expansion erodes the dollar's purchasing power over time. As an illustration, Holter points to gold's dramatic increase in value, from $270 in 2000 to nearly $30,000, highlighting a roughly 90% loss in the dollar's real value. Amid rising tensions and economic pressure, there is also speculation from some investors that China may be selling off U.S. treasuries, potentially as a response to ongoing tariff disputes. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
As for Germany, that was back in 2013, 14. That was 10 years ago. I think they asked for 320 tons. It was a little over 300 tons. And at the time, because they came out and they said, oh, it's going to take several years to do. At the time, I looked up what a 747 cargo jet could carry, and they could carry 95 tons. So that could have been done in 4 shipments. And obviously, now that we've seen, 500 plus tons of gold moved from Europe to the United States, shows that, yes, it can be done. And the excuse that they used back then that, oh, well, it's just too heavy and it's too much money to do in a short period of time. It's going to take us 2 or 3 years, which it did. And then when Germany got their gold, it was not even their gold. The gold that was received had completely different serial numbers on them. So something happened to Germany's gold, and now they're considering again withdrawing more gold. And it wasn't from COMEX; it was from the Fed itself. So it was from New York vaults, but it was being held by the Fed, as I understand it. And I think it just makes sense that more and more, the more lies, outright lies that are discovered to be outright lies, is ruining confidence of foreigners. And foreigners are saying, hey, we want our metal back. We want it back. We want to hold it, because if it's in your hand, you have it. If it's held at the Fed, they're probably bullshitting you and your metal's already gone. So I think this is a move to basically take reserves and re-homeland them by foreigners. Just understand that U.S. treasuries are the foundation to the global financial system. They're the foundation for everything. And it used to be, years and years ago, gold was the foundation. Gold was a strong foundation. The problem with treasuries is that treasuries are issued in dollars. They contractually promise more dollars. And as the money supply gets printed and created, the dollar loses value. I mean, just the illustration, 270 gold to 3,000 gold, that's, the dollar since the year 2000 has lost 90% or more than 90% of its purchasing power. The danger is that foreigners completely shut down and say, we're not buying any more treasuries. Not only that, we're going to sell the treasuries we have. Well, who's the buyer going to be? The buyer could only be the Federal Reserve. So the buyer of existing treasuries and the lender to the treasury for new treasuries in order to deficit spend or cover the deficit, the danger is that what has been outright monetization becomes outright public monetization. In other words, the public and foreigners, that human beings will be able to see that the U.S. Treasury has limits to what they can borrow, and that limit boils down to whatever the Fed can buy and whatever the Fed can lend. And outright monetization, I mean, all you have to do is go back through history. Anytime a government monetizes, the currency goes away, the currency evaporates.
Silver showed mixed movement in early Thursday trading, hovering near the 200-day exponential moving average, a key technical level. The market gapped higher at the open, a bullish signal, and is now testing the $31 level, which could serve as a breakout point if surpassed. However, silver is still recovering after several days of sharp declines, and short-term volatility is likely. The recent 90-day pause on tariffs supports silver's outlook. Silver is a precious metal that is also heavily used in industry. This industrial demand adds strength to a stabilizing global trade environment. According to BillHolter, the current gold-to-silver ratio near 100-to-1 suggests that silver is deeply undervalued. He advises new investors to allocate about 70% of their precious metal holdings to silver. As silver gains ground and the ratio narrows, converting silver into gold can increase total gold holdings over time, making current market conditions favorable for long-term silver accumulation. Let's get back to the interview.
Because of the ratio, and now we're close to 100-to-1, takes almost 100 ounces of silver to buy 1 ounce of gold. You want to concentrate on gold. You want to concentrate on silver. You want 70% or more. If you're just starting out, you want 70% or more in silver versus gold. And then at a later date, as silver outperforms and the ratio comes down, then you look to start swapping silver into gold, and you'll end up with more gold ounces. When the ratio comes down to 50, 40, 30, as silver outperforms, you're buying cheaper gold with more expensive silver. So you end up with more ounces. As for the U.S. Mint lineage, the reasoning behind that is, for instance, I mean, if you buy a gold eagle today or you buy a silver eagle today, the mint is basically selling it to you through a broker conduit. It'd be really difficult for them to sell eagles to you today and then next week and say, oh, by the way, we're confiscating it, you have to sell it back. Now, could they do that with Maple Leafs or Krugerrands or bars or whatever? Yeah, they could do anything they want. And they could do something with U.S. Mint lineage coin, but there will be lawsuits and there will be lag time where there would not be with foreign sovereigns or bars or generics. With silver, I believe it's hands down that you want to own junk silver. It's the smallest form, 14 dimes, roughly 14 dimes equals 1 ounce. So that's going to give you 14 barter transactions in a system down scenario versus one, whether it be a bar or a round or a foreign sovereign or even an eagle. So you want the smallest denomination. They are U.S. Mint lineage. They're readily recognizable. They really can't be counterfeited because junk can't be shiny. Junk needs to look like crap. It needs to look like it's been used because it was used. And when I said readily recognizable, as long as the coin says on it 1964 or earlier, you know it's a 90% silver content. So for silver, I think hands down, you want to do junk. Switching to gold, again, you want U.S. Mint lineage coin. It's much more likely that gold would be confiscated than silver. And just to mention on potential confiscation, it's my opinion they won't go after individual holdings. It's far more likely, in my opinion, that they would nationalize mining operations. They'd get more gold faster doing that. But as far as gold, you want either eagles or buffaloes or 333 gold, which are the Liberties and St. Gaudens. they're as cheap as I've ever seen them in relation to spot. I mean, you can buy, I don't know, an MS 62, 63 Lib or Saint for basically the same price as an Eagle, or maybe even slightly less. So the pre-33 gold, which, a lot of people shunned in past years because they had a 20 or 30% premium over spot. There virtually is no premium over spot, and now's the time to buy those.
The growing wave of gold repatriation and silver accumulation reflects a clear pivot toward asset sovereignty amid escalating global uncertainties. As nations reassert control over their bullion, the underlying message is a caution against overdependence on foreign financial hubs. Simultaneously, silver's strategic dual role, as both a monetary hedge and an industrial staple, positions it uniquely for potential growth, especially given the current imbalance in valuation compared to gold. This evolving sentiment signals a more profound shift in how countries and investors perceive long-term financial security. Could this move toward domestic metal holdings and strategic silver positioning redefine global trust in fiat-backed systems, or is it a temporary hedge against current volatility? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.